Hello and you're very welcome to this video. In this video we're going to be finishing off unitary management, and we're going to continue on in our from the last video learning about the management activity of controlling. In the last video we learned about stock control. In this video we're going to learn about what quality control is, what the ISO 9000 is, the benefits of quality control, what credit control is and the benefits of credit control, what financial control is and the benefits of control to a business. So, what is quality control? Well, as it sounds like, it's to do with the idea of the quality of the product. It's concerned with checking, reviewing, inspecting work that is done to ensure it meets the required standards. As part of a quality control system, the business may achieve a quality control symbol such as the ISO 9000 award. In your answer, if you're asked about quality control, you would need to mention the ISO 9000 award in order to be able to get full marks. This symbol may be recognised worldwide and will be of huge benefit to the business in marketing its products internationally. Basically, if you see the ISO 9000 award on a product, that means that that particular product has gone through a certain amount of rigorous checks to ensure it meets a certain quality and therefore is of decent good quality, so you know as a consumer that you're buying it that it's going to work well. The benefits of having good quality control, that reduces waste. What we mean by that is that if you're making products that are faulty, you'll end up having to eventually dump them. So if you're making good quality products, that means you're not having to try it as much. It reduces costs. When consumers have to return items because they're faulty, that ends up costing the business money. If you're producing goods of good quality the first time, that means you're going to be saving money. Increases customer satisfaction. If consumers are buying goods that are of good quality and don't break, well then obviously they're going to be happy because they're buying stuff that does what it's supposed to do. Therefore, they are going to be repeat customers for the business, which is exactly what the business wants because that boosts their profits overall. It also promotes the quality of the brand. If a brand gets a good reputation for being associated with good quality products, then consumers are more likely to be loyal to that brand and more likely to purchase products from it. Next up, we look at the idea of credit control. Right, if you think of credit, we're thinking about money and the selling goods on credit. Think of your credit card, buy now, pay later. Credit control means controlling the amount of credit, i.e. the payment given to customers, and ensuring that payments are made on time. It involves checking credit worthiness of customers, setting credit limits and periods, deciding penalties for late payments, and reducing bad debts. When goods are sold and payment is not made until some time into the future, a trade debtor is created, leading to a possible risk of bad debts. There will also be an increase in administrative expenses to the business, for example, invoices, credit notes, etc. So, to explain this, what often happens with businesses is that businesses buy goods from another business on credit. In other words, they receive the goods now and they're buying them now, but they're not paying them till a later point down the road. Often a period for this between businesses 30 days credit. Businesses need to be mindful as to how much credit they give out to businesses, to other firms. If they give out too much credit, they may not have enough money to pay their own bills. They also need to make sure they're giving credit to people that are likely to be able to pay it back. A lot of firms will therefore give a credit limit as to how much they'll actually let them buy on credit. They also need to have sure they have systems in place that if they are late paying, that they will be checked up and followed up on to make sure that they actually pay, and that there's penalties to ensure that they pay on time, that they're not going to be late in paying back. The benefits of good credit control is the firm controls the amount of goods sold on credit. Debtors pay debts on time. Debtors are people who owe the firm money. Bad debts are kept to a minimum. Bad debts are debts that basically will never ever get paid back. So say for example, if you give your mate €1 to buy a can of Coke in the shop, and they just keep saying they forget to bring the money in, after a while you're just going to stop asking your friend for that €1 back, and you'll just say, oh look, I'm never getting that back. That's effectively called a bad debt. So when a business realises, look, we're never going to get that money, so we're just going to write it off and take the loss themselves. The credit worthiness of potential customers is checked in advance. The credit worthiness basically means is how likely they are to pay back. So if a firm has a reputation for never paying their bills, then they're probably not going to pay you back either. So there's ways firms can check to see, are they likely to actually pay back. Also, good credit control will ensure the maximum cash is collected from the debtors. So that means that all the money they allowed to be paid later is actually paid back. And firms do not have to rely on bank overdraft to deal with cash shortages. A bank overdraft is when you your bank balance is a negative figure, so it's like a short-term loan from the bank. Obviously, you don't want to do that because you have to pay charges, the interest charges to the bank on that. So if you give out too much credit, you will end up going into an overdraft in order to pay your own bills because you're short of cash, and that's obviously not an ideal situation. The last type of control we look at is financial control. Financial control is used to monitor the financial affairs of the business to ensure that it is profitable and always has enough money to pay its bills. Advantage, which is fairly straightforward, really. So basically, financial control to make sure you have enough money in your account to pay what you need to pay, what you owe. So the advantages or benefits of control in general. Stock availability. Well, it's important. Control is important because it makes sure the business has the right stock available to sell to its customers. It reduces waste because control helps to ensure that resources are not wasted and improving efficiency and increasing the profit and productivity of the firm. It also improves the cash flow. Good credit control and financial control ensures that the business would have sufficient funds to pay their bills as they come due. And the last but not least, improves quality. Good quality control ensures that the goods produced are of a set standard, reducing the numbers of returns, which reduces costs and increases profits. This also improves the reputation and reliability of the business. In that last section there, basically what we did, we took the main benefits from each of the other sections and then we took the main benefits from each of the sections of control and compiled them for one generic answers. So, to go through quickly what we went through there today, so you should now know from this video what quality control is, what the ISO 9000 is, the benefits of quality control, what credit control is, the benefits of credit control, what financial control is, and the advantages or the benefits or the importances of control to a business. I hope you enjoyed this video, and if you enjoyed it, why not give the video a like? Also, why not subscribe to the YouTube channel as well for more wonderful videos about leaving cert business and other stuff like that as well. Thanks very much for watching. See you now, folks. Bye.